Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right, well, the market was surprised this morning. The CPI data, which is the data that tracks inflation, did not give any hints that inflation is slowing down. The numbers were greater than expected, but probably more importantly is that the marketplace was expecting a decline. And one of the biggest things about inflation is not necessarily how much of a change that we had, but people keep claiming that, inflation has peaked. So it's a lot more about the direction of inflation as opposed to how much it has waned. And in this instance, it hasn't waned at all. Inflation actually increased on a lot of the numbers, including the core inflation, which is the big one that the Fed watches. On that news, there's mutterings that the Fed might actually increase the Fed funds rate by a full point this time around. A little bit more muttering right now, but the concept of half a point has gone out the window. And right now, they're definitely leaning towards 3/4 of a point, according to the CME, Chicago Mercantile Exchange, Fed Watch tool, which is based off of the futures. So at this point in time, the likelihood is that it's going to be 3/4 of a point, but people are actually mentioning that maybe based off of these numbers, we might see a 1% move in the Fed funds rate, which I really don't anticipate that at this point in time, but it was shocking to the market. We currently have the S&P 500 index down 3%, and the NASDAQ is down 4%. The small caps, the Russell, is down right around 3% overall. The VIX has spiked. Right now we're showing the VIX index up to 25.85. And, so far September has been a fairly good month. You could actually say we were up going into today. Since September 1st, we were up about 5% on the marketplace. Who knows where we're going to end up at the end of the day because we've just retraced that whole move all the way back. As I mentioned, the NASDAQ right now is, well, I should say the S&P 500 index was up about 5%. Now we're down 3%. So net, we're still doing okay considering that it is September, one of the worst months of the year historically. No rhyme or reason to it, except for the fact that if you just go back and look at the numbers, historically, September has been one of the worst performing months for the S&P 500 index or the market as a whole. All right. So definitely got volatility. Volatility has been added. I've talked a ton. I'm showing the VIX watch list right now, and I actually have the VIX index trading right now at 2586. We were talking about it down around the 20 level, how it was kind of crazy going into September, that we had the implied volatility of the options in the S&P 500 index, that's what the VIX tracks, trading down around a 20% level on the 30-day basis. And we got to spike back up to around the 25 level. Still haven't had that huge move in the VIX, showing a little bit of capitulation in the marketplace, all the way up to the 35, 40 level. We have not seen that at all. And I'll just scroll back and we can kind of look at it. Even though we've had bearish markets all the way down, we really have never had that spike up going all the way back to the pandemic. And I'll zoom in just a little bit more. I'm hoping to. All right. Going all the way back to here, the highest that we've ever gotten was around 38, almost to 39, never even hit that 40 level, which, those are magic numbers in the VIX. A lot of people watch the highs in the VIX. They think of it as a shaking out of the markets, where when the VIX gets up high and the panic level is high, is usually one where it's supposed to be a contrarian indicator. Well, some people will say, and means that you've shaken out a lot of the sellers in the marketplace, and it's normally considered a bullish sign in the market. Okay, so we had some bad numbers. Everybody was kind of getting excited about the CPI report over the last week, really anticipating the fact that inflation had peaked. We still have a potential big recession in Europe. We've got some good news going into the week, in that a lot of the European markets have claimed that their reserves for natural gas and other heating oil type products are getting to full capacity, and that alleviated the marketplace a little bit. But with that said, there's still that black swan event that can happen. We still have, obviously, the geopolitical concerns between Ukraine and Russia. There were bombs that were being tossed around, nuclear power plant. We're in hurricane season here in the U.S. The one crazy event or unanticipated event could be a real big tipping point. Some might say that the CPI number was a fairly big tipping point right now. But the question remains, if Europe does go into a recession, will they drag us in with us? We see the dichotomy between the 10-year and the 2-year is getting wider and wider. Everybody used to say that when that happens, that means we're going into recession. Some people make the argument that we're not there yet, and it's mainly because of unemployment numbers. And to have such strong employment usually will imply that we're not in a recession. You need to have higher numbers in order to slow the economy down, slow the wage growth, everything that's involved. So definitely an interesting day in the markets. We did see oil come off a little bit, so that's, I guess, a highlight, I would say. We're seeing... I'm looking on my VIX watch list, and we have the USO right now, which is the ETF that tracks the oil futures, is down about 1.75%. So it's a significant move to the downside. So we're still seeing gas prices, oil, a lot of the commodities still coming off a little bit. Food prices are I think, the biggest driver of all of this inflation. Consumer is befuddled, but still fairly strong. But we're going to get some more consumer data at the end of the week, which will be real interesting considering what we saw from CPI this morning. All right, so let's jump into it. Last week, we were talking about energy, and been talking about energy for quite some time. So we went in and looked at ExxonMobil. So if I pull up a chart, I have the Qs up right now because that's going to be the stock of the day, but I'm going to put ExxonMobil in, okay? And more so just to say that last week we sold a put spread, and it was a speculative play. we've been looking at a lot of the energy stocks and kind of posed it as a fear of missing out. We did longer term, deeper in the money option contracts in some of the futures or in some of the energy stocks that we talked about. Occidental Petroleum, we looked at selling a put to try to buy some shares of the underlying stock. But right now, if we see ExxonMobil, last week, we'll go 5 days. We'll just look at the 5 days. This will be a 15-minute chart and basically cover, since we talked last week, what has happened with ExxonMobil. We were right around the 94 level, I think, when we were talking last week. It might have been up around the 95 level. If we scroll out here a little bit. So we did have a move down towards the 93 level, but it's been fairly strong. Now we've gone all the way up and hit the 99 level, and that was on the 12th, pretty close to the open. So we had a lot of strength in ExxonMobil, and now we broke through. Now here's the biggest thing is that we had here what is called a death cross as far as the chart is concerned, where we actually crossed the 20-day moving average, crossed the 50-day moving average. And on this 15-minute chart, we definitely have a little bit of a downward trend in the marketplace. But with our trade, we went out longer in time. We went out to the October 21st expiration. We sold the 85 put and bought the 82.50 put. So I'm going to run to the option chains now here, and I'll pull up that trade. It still is basically staying the course. And if we set up a plan when we sold the put spread last week, we were neutral to bullish on the marketplace is what our outlook was. And now we're basically just going to be staying the course because we did have the rundown, and the one spot where I would get nervous or where I would think about adjusting the trade is if we get closer to our short put strike. The put strike that we sold is the 85 put, and we did mention last week that implied volatilities are up in a lot of the energy stocks. Well, they're up in the entire marketplace, but they are also up in a lot of the energy stocks. So with that mentioned, that was a big reason why we wanted to do the trade. And then we're looking, even though we're going all the way out to October 21st expiration, which we have in our chains here, even though we're going all the way out to that expiration date, we're hoping that implied volatilities will come in a little bit. We can capture as much as we can of the premium that we sold on that 85 strike put. We managed our risk by only going 2.5 points out of the money. So right now, if I just stay the course on the trade, we're doing okay. It's not that bad of a situation. Right now we're seeing we could sell this for a net credit of 30 cents. If I recall last week, we came close to 50. We really wanted to get a 50-cent net credit to the account. But I think ultimately when we were taping the show, we do everything live, it was right around 45 cents. My biggest goal here is if the market did stay this way and I could close this out, especially in the short term, for around 15 cents, I would think to do that, and that would be my goal if I approach it. If I'm looking at a 2.5 point wide spread, I'm trying to bring in around 50 cents. If I'm doing a 5 point wide spread, I'm usually looking to try to bring around $1. And that has a little bit, there's a lot to do with the pricing, where the delta would be. The probability of it actually finishing in the money is fairly low if you're looking at that type of credit on a spread. It's all based off of what the implied volatility is saying about the option contracts in that expiration month that you are trading. So we'll come back and we'll revisit it. If the market does come down towards the 85 level, we'll look at an adjustment, but there's absolutely no reason to do that right now. As I mentioned on last week's call, if 20 days go by and the market just kind of stays where it's at, I'm going to close it out anyways. I don't want to be in this position going all to expiration. And this is more of my standard. If I'm looking at, I think ExxonMobil really kind of sums up underlying, and this is what Options Playbook is all about, is trying to find underlyings that fit strategies. And my goal with selling a put on a specific underlying, a put spread on a specific underlying, not on a specific index, is to have some volatility with some predictability, which is a little bit of an oxymoron, but we're in the energy stock. We've had a fairly big move up. They've kind of came off of their highs now. So we have decent volatility. As a matter of fact, we might even say high volatility, but we still have ExxonMobil, right? It's still ExxonMobil. It's still an energy company that prior to this big run up was a fairly stable, didn't move a lot type company. And Occidental Petroleum was the same one that we've talked about. We looked at Devon Energy recently too, and just because we're talking about the dividends. ExxonMobil is actually part of the aristocrats, and that's a list of stocks that, and there's some ETFs that are based off of it, but that have increased their dividend. I think it's for over like 10 years. And ExxonMobil is in there. I think Chevron is also one of the stocks that's in there. Devon Energy, because of the way that they've structured their company, increased their dividend over 30%. This in I should say last quarter or last time that they paid a dividend. All right, interesting little tidbit. So today now, this is a speculative trade, even though we went further out in time. We still had a plan to get out within 20 days. So today we're going to look at the QQQs. All right, so let me get up the QQQ chart here, and we'll just take a quick peek at it. There, none of the charts, none of the major indexes. Well, the QQQ is an ETF that tracks the NASDAQ, and none of the charts look pretty. Let's just put it that way. Let's go 6 months in time. That was the 15-minute chart. And we're quite a bit below the 200-day moving average. We definitely don't have our ducks in a row. We did have this golden cross here where we had the 20-day cross over the 50-day. I put a lot more weight on it when we were dealing with 200-day moving averages as opposed to the quicker moving averages. But right now we're kind of in a downturn. We're bumping up against the 200-day average, and here's where we're at. Had a pretty big down day, which makes sense around the news. So let's continue with that, and let's going into the end of the week. We have some retail numbers. Let's get bearish short term, and how would we do that in the Qs? What we're going to do is a long put spread. So I'm going to run to the strategies tab inside the options playbook. And we're going to, because we have the premium, we have the increase in the VIX, we don't want to just buy a put outright. So what we're going to do is we're going to buy a put, and we're going to kind of straddle the marketplace. We're going to go a little bit in the money, we're going to go a little bit out of the money, and we're going to do it on a shorter term basis. So rumor has it that September is not a good month to be investing in the marketplace. We had some poor news that surprised the marketplace. So once again, we're trying to take plays that are inside the options playbook and make them fit that underlying. So we have this underlying, we have high implied volatility. We surprised the marketplace. How could we speculate on this move to the downside continuing? And that's what we're going to do. We're going to look at a long put spread in the QQQ, which is an ETF that tracks the NASDAQ Composite Index. All right. So if I run back over to the option chains, I'm going to pull up the Qs inside the option chains next. And we will go out about 2 weeks in time. Now, there's a lot of different expirations in the QQQ. Not quite as many as in the SPY, but there are a lot of different expiration dates. So we're going to target this 15-day September 28th expiration. And I'm pretty sure, I want to make sure that's the Friday. No, 28th is a Wednesday. So we're going to do the Friday expiration, which would be the 30th. All right. Like I said, a lot of different expirations on it. And right now we have the Qs trading at 298.30. We're going to go a few points in the money and buy a put, and then go a few points out of the money and sell a put to help pay for it. So our goal here by doing it that way is we want to take a lot of the time value out of the strategy. We're going to be buying approximately the same amount of time as we're selling. That means that all we're really focused on is the price and obviously days to expiration. And if we're doing this, this is definitely a speculative trade. and not meant to be a recommendation. I always have to say that inside stock play of the day. All right, so now we got a few more strikes. We're going to go out to the 17 days away, going to September 30th. And we're going to go, well, right now the market's at 29.90. Yeah, I guess we'll do the 301. And we're going to be buying that option contract. And you can see that that is an expensive option contract. It's $9.46. But what I want to pay attention to here is what's the call trading for? The call's trading for around $6 or $7. And our goal is to sell something that has about that amount of time premium. By looking at the call, this is just a little shortcut, it tells you the approximate, and it is approximate, it's not an exact science, amount of time premium that you're buying on your put option. So interesting enough, a simple way to just do this trade is you're buying the 301, so we're about, how many points are we in the money? 3 points, 298.02. So we're 3 points in the money. Ideally, I would go about 3 points out of the money, and that should be trading for about the same amount of time premium as the option contract that we bought. Now, the concept is that all the time premium sits on the at-the-money option contracts, and it gets smaller, and especially in a very efficient market like the QQQs, as you go further out of the money, right? Time premium is going to go down because you're further out of the money. It's going to be trading for less. But it's also the case on in the monies. As you go further and further in the money, the option represents more and more intrinsic value and less time value. Equidistance in and out of the money is going to be about the same amount of time premium on that in the money option as and obviously on the out of the money option contract. So the 295 strike is trading for $6. We could go down to 294. How much time premium we got here? 650. So we're right in the cusp. 3 points would be 6 points wide. So we'll go to the 295. Make it simple. Costs will come down a little bit as opposed to doing the 294. And we're going to be selling that. All right, so let's scroll down to the Ally Invest option strategy workbench. And well, here we're going 6 points wide. We are actually selling a little bit more time premium than we're buying. If we sold the same amount of time premium on a 6 point wide spread, the midpoint would be $3, but it's $2.75 here. That means that if the stock just stays where it's at, we're going to actually be profitable, because even though we're paying a net debit for this trade, we are selling more time than we are buying. And because of that, the market just stays where it is at, we would be profitable. We ideally want it to continue on down, and we want it to go below our short strike of the 295. And if it does that, the maximum we could make would be 275, that debit that we paid, minus $6 or $3.25 less commission. Okay, so I'm going to put this in the right rail. And while I do that, I want to let you know that this is an interactive show here, Stock Play of the Day. If you have any questions, please put them in the chat box. We can talk about the ExxonMobil trade if you'd like. Obviously, talk about the QQQ trade, this week's paper trade that we're looking at. And any other questions that you may have. We want this to be as interactive as possible, so please feel free to put them in the chat box, and I will take a peek at them a little bit later on. All right, so the official paper trade with the QQQs trading at 98, we'll round down to 98. We're going to be buying the September 30th 301 strike put, then selling the same time, that same expiration, 295 strike put. We're going to do this, well, when we looked at it, we're going to make the math simple. We're going to go 275. That would be a really good fill if we could pay that. But the market's really tight in this. So yeah, there it goes right back down. I would definitely put in a limit order right around 275. You're never guaranteed to get that price whenever you put a limit in, but I never trade spreads on any marketplace and just enter them at market. Mainly because you have two different option contracts and you want to work that order a little bit. So $275 for every 1-by-1 spread, less commissions. That's my total risk. Upside is the width of the spread, which is 6 points, minus $275 or $325 less commissions, $325 for every 1-by-1 spread that you do. All right. So let's close the right rail. And as you're putting the questions in the chat box, I'm going to zoom in on the Ally Invest profit and loss calculator. Okay. So the thing that I'm going to highlight, the dotted line is at expiration. The colored line is as of today. And this line right here is the actual stock price currently. Now you see right at the break even, the blue line, the horizontal line, that means that we're fairly close there, right? That's exactly where the stock is at. And you'll notice that if it stays right where it's at on the profit and loss graph, we're going to be up a little bit. We'll be up about 25 cents on that trade. And that's what I was highlighting. The fact that we bought less time premium than we sold makes that break-even point be where it is. Now, as expiration approaches, to start with, we still got a lot of time value. There's a lot of juice in this marketplace. So if it goes to $295 tomorrow, we're not going to get rewarded that quickly. We need some time decay to happen to get up to the dotted line closer to the expiration, or ideally we would have implied volatilities come in. That would help. But on the downside, very rarely do implied volatilities go down as the market goes down. But here's the good news, is that if we're wrong right away and the market goes up towards our long put strike, well, it doesn't hurt as bad either. Now, as expiration approaches, I'm gonna make this quick because we're coming to the end of the stock play of the day and I want to answer some questions. I'm going to go straight to 1 day remaining to expiration, and you graph that. Now you see the as of today line start to morph into the dotted line. And if you're correct on your forecast, you want to be more correct on long put spreads closer to the expiration date. So it's a bad thing if you're correct too fast in your long put spread, but it is a good thing if you are not wrong. Said that backwards. If you are incorrect in your forecast, the time premium helps you, it saves you. If you are correct in your forecast, the time premium in the option contract that you sold works against you. It does not want the market to come down and be an at-the-money option contract. So you need time decay in order to maximize your profits in your long put spread. Okay, so let's go in. I got a couple of minutes here to answer a couple of questions. Arun or Arjun is saying, what could be the effect on it on companies in India? What could be the effect on companies in India? I think the biggest concern, the U.S. is, just by looking at the dollar index, the U.S. has been strong. The dollar has waned a little bit recently, but it's still been strong compared to almost all the currencies. I think a big effect is just what's going to happen in the winter season and how Europe in general going into a recession might affect all economies. It's going to be really hard for them to avoid a recession, and they're trying everything. It's in the headlines. They're debating if they're going to cap the energy bill prices. The war, we don't know what will happen geopolitically with Ukraine and Russia. There's a lot of headlines that are in that area. And I think that my biggest concern, my biggest worry is the unknown event, the black swan event, if you will, that could happen, that could just even create a less good situation when it comes to energy and trying to heat during the winter season. So, yeah, inflation numbers being high in the U.S. are hurting everything globally, but I'm more worried about what's going to happen this winter season across the globe. Some areas, obviously, we're not going into winter, but with that said, it's a concern, a big concern in Europe. All right, any other questions that we have in the chat box? Anything about the strategy? Anything that you'd like us to try to cover? And if not, we're at time. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of The Options Playbook. Please click subscribe, ring the bell, let people know about this event. We want it to be interactive. So we'd like to get as many people to show up while we're taping. That's why we're doing it live as possible. So share with friends and family. It's free for all. Thanks for coming, everyone, and we'll talk to you this coming up Tuesday.